On Business Incorporated today, AFDB and its partners unveil initiative to secure climate-resilient water and sanitation services in 5 African countries. Egypt becomes Africa Finance Corporation's 32nd member state with potential of $1 billion of investment. East African Business Council signed agreement with Afri-Exim Bank to roll out the African Customer Due Diligence Platform. Thank you for joining us and welcome to the program. I'm Chimeze Obi Iwago. We'll get the show started with the intraday market numbers, and starting off here on the African continent, it was mixed sentiment at intraday. Nigeria's NGX traded in the green, marginally up, while JSE index in South Africa was in the red, down a massive 2.11%. Elsewhere, the EGX 30 in Egypt was down at 22 basis points, while Kenya closed positive at the end of Wednesday's session, up 0.61%. In the Middle East, most markets we track were in the positive territory at intraday. Only Saudi Arabia faltered. In the UAE, Abu Dhabi was up over 1%. Dubai was also up, though marginally at 0.03%. Elsewhere in the region, Saudi Arabia lost 0.37%, while Qatar gained 0.32%. In Europe now, stocks retreated in early trade as investors in the region watched for announcement from the European Central Bank. Chelsea has been tracking that and joins us now. Hello, Chelsea. Good afternoon. Well, the European Central Bank has just released its latest policy announcement. What do they have to say, or what have they decided?
Well, to me, the biggest news out of today's meeting is that the ECB does plan to start reducing its bond buying in the months ahead. Right now, the European Central Bank is buying about 80 billion euros worth of bonds every month, and that's basically helping to keep companies and keep governments it's allowing them to buy, to borrow money and to continue spending at very low interest rates. So the ECB does plan to start reducing that potentially by about maybe 10 to 20 billion euros in the months ahead. That's not a huge change. It doesn't mean that the ECB is cutting off support to the economy. So I think investors are not too worried about this right now. The other things that is going to be very important is how ECB President Christine Lagarde, who is speaking now, discusses the concept of inflation. Inflation is at a 10-year high here in Europe right now. What we've heard so far from European policymakers is that they're not too worried about this, that it's temporary and that it should start to fade, potentially going into next year. But it'll be interesting to see if President Lagarde has changed her opinion on that. And of course, the other cloud hanging over the global economy right now, the Delta variant and the coronavirus situation, and whether that will have an impact on growth here in Europe and the prospects for the withdrawal of stimulus.
And markets have become highly dependent on ECB stimulus. What does this mean for investors?
Well, judging by the response that we've gotten so far, investors are taking this in stride. The DAX, as you can see behind me, did go up a little bit actually after this announcement. So perhaps investors were a little bit more worried about a stronger statement from the ECB. As I mentioned, the reduction in bond purchases is not too dramatic. And as well, the ECB is really stressing that they remain very flexible, that if the economic situation worsens, that they could actually ramp up that bond buying once again. And then over the longer term, the ECB is not really expected to stop these bond purchases until maybe 2024. So we're still looking at several years ahead with the ECB providing a lot of easy, cheap money to the markets. And so I think that will ease some of these concerns from investors that we're heading towards an imminent sort of drop off in these very supportive quantitative easing policies from central banks.
And in another development, American chip giant Intel wants to invest as much as 80 billion euros into building semiconductor factories in Europe. Will that help ease the chip shortage?
So in the near term, this won't really do much to help the situation with semiconductor shortages. Basically, much of the European economy right now is struggling with the fact that it's very difficult to get semiconductors right now. We've seen a lot of the big automakers, for example, have to cut back on production and even in some cases shutter production lines temporarily. So Intel is saying that they do plan to build out a much stronger semiconductor capacity here in Europe, and the EU has been actually lobbying Intel to get them to do that. So it's definitely going to be welcome news here in Europe, but it's going to take quite a long time to build these factories. The Intel is expected to announce the locations before the end of the year. Germany is seen as a strong contender because they've offered some financial incentives to Intel to build here, but this is still a prospect that's going to take years, so it won't really help the near-term situation, but demand for semiconductors is only going to get stronger. It's only going to increase in the years ahead, so it could prevent another situation like this potentially 5 to 10 years down the line.
A welcome one indeed. Thank you very much, Chelsea, for updating us on those, and see you tomorrow. In the meantime, growth worries pushed the UK's FTSE 100 index of blue chip shares to a 3-week low in early trading. For intraday market update, let's bring in Juliana now. Hello, Juliana. Good afternoon. Well, the FTSE started off in the red today with the Bank of England governor seeing signs that the UK's recovery is slowing, and of course, Fed signaling U.S. economy downshifted slightly. Bring us up to speed with market numbers at intraday and what is in the minds of investors.
Good afternoon, Chimeze. You're right. I think it's, sentiment really is laying on the shoulders of central bank governors. I think the ECB and will they, won't they start tapering down that 1.5 trillion euro stimulus package has certainly been on the mind because, of course, once they do that, it signals the start for the rest of the central bank governors to do so. I know you've been discussing that extensively with Chelsea, so we'll just have to wait and see what happens across the pond with the Federal Reserve. As you were saying, the FTSE blue chip index is nursing almost a 1-month low. There's been a mass sell-off. It started this morning. It continues at intraday. And the all-share at intraday is down 1.05%. The FTSE 100 is down by 1.25%. And the FTSE 250 is down by 0.58%. In the currencies market, the British pound is up on the US dollar by 0.35%, up against the euro by 0.25%, and up against the US dollar by 0.06%. I think the mass sell-off has really been led by airlines, Chimmy.
Talking about airlines, EasyJet and, of course, Morrison's are on the news today. EasyJet rejecting a takeover offer, while Morrison's reports a drop in profit. So, talking about EasyJet now, what's happening to the shares? I believe will be down now, and, of course, Morrison's share.
Well, absolutely, yeah. They're the big kind of corporates in the news today on the FTSE 250. EasyJet, the main story was supposed to be the fact that they were seeking to raise over £1 billion from shareholders to kind of weather the pandemic storm. We're coming towards the end of the third quarter. And of course, that is supposed to be the busiest quarter, particularly for low thrills airlines, because people that can't usually travel during the year always try to get some summer sun. That hasn't been the case because it's still been a pretty chaotic travel system here in the UK. They're only flying at 60% of their pre-pandemic schedule. But alas, the headline was taken over by bosses rejecting an unsolicited takeover bid. Still unconfirmed that the bid was put forward by their low frills competitor Wizz Air, which is the Hungarian flag bearer. We're not sure how much they put on the table, but apparently it completely undervalued the business. But as soon as that announcement was made at early trading, their shares were down by about 15%. Mid-morning, down by about 9%. The last time I checked, it was down by between 7 and 6%. So, investors not really happy that they decided to shrug that off. And Morrison's, we discussed this at, I think it was exactly the same time yesterday, about the takeover panel, the bid between Clayton, de Billiere Syrian rice and Fortress, which is still going ahead. But this morning, they did announce that they've lost money in the first 6 months of the year. Lots of this is due to COVID-related impairment payments that they've put aside, but also they've lost money through fuel, cafes that have been closed, and other items. So even though this time last year supermarkets were doing exceptionally well, it seems as if that buzz is beginning to taper off.
And of course, in another development, Brexit-related hurdles still taking a toll. Official German statistics suggest the UK is expected to drop out of the list of Germany's top 10 trading partners by the end of this year. Now, the UK has been in Germany's top 10 trading partners since 1950. So what impact will this have for the UK?
Yeah, it's a pretty big story. I'm sure this is certainly going to be mentioned during Prime Minister's questions next week. But as you said, for the first time in however many years, Britain has dropped out of Germany's top 10 importers. I believe 11% less was imported from Britain into Germany this year, as German businesses are pretty much looking elsewhere to cut costs and savings. Since the 2016 Brexit referendum, Germany has kind of been reining in their relationship with Britain anyway. And according to a recent survey conducted in the country, about a fifth of German businesses are trying to find alternative solutions because, quite frankly, the Brexit, cost barriers and hurdles and bureaucracy is just far too expensive and too timely for them. This was always going to be the case. I think, for British ministers, they said that this was going to happen, which is why they're looking for trade partners elsewhere. But I think it's a pretty sobering moment, considering Germany, of course, is Europe's #1 economy. And the fact that German businesses want less British goods is going to be a huge blow, particularly to the main sectors that are being affected, which is the pharmaceutical industry and agriculture.
All right, Juliana, let's do this again tomorrow. Enjoy the rest of the day.
I can't wait. Thank you.
Okay, Hong Kong stocks fell in Thursday's trade, with shares in the rest of Asia Pacific also largely declining. The broader Hang Seng index in Hong Kong dropped 1.6%. Shanghai Composite in mainland China hovered fractionally higher, while the Shenzhen component dipped 0.62%. China's consumer price index rose 0.8% year on year in August, compared to expectations for a 1% increase. Meanwhile, the producer price index jumped 9.5% from a year ago, as compared to forecasts of a 9% rise elsewhere. The Nikkei 225 in Japan dipped 0.46%, while the Topix index fell 0.48%. South Korea's Kospi declined 0.9%. In Australia, the S&P ASX 200 fell 1.41%. And in the U.S., stock futures were lower in early morning trading as investors remained cautious on the remaining months of trading. Dow futures fell more than 160 points. S&P 500 futures and Nasdaq 100 futures both traded in negative territory. Dysfunction in the labor market amid the COVID-19 pandemic was reinforced on Wednesday when the labor market's job openings and labor turnover survey showed job openings outnumbered the unemployed by more than 2 million in July. The report, which the Federal Reserve watches closely for signs of slack in employment, showed open positions soared to 10.9 million in July, well above the 9.9 million FactSet estimate and the 10.2 million from June. Investors will be watching for the latest weekly jobless claims data set to be released later today for a greater look at the employment picture. And on global oil market, prices rose for a second session this morning, recovering from earlier losses as a decline in U.S. Gulf of Mexico output following damages from Hurricane Ida underpinned the market. Brent added 23 cents to $72.83 a barrel, and West Texas Intermediate crude rose 15 cents to $69.45 a barrel. After the break, South African government distances itself from mandatory vaccine policy for employees. This and more in a moment. Stay with us. there. South Africa's vaccine rollout improved with a significant increase in the number of people going to get their jab, and there is a sense of hope of reaching government's target. As encouraging as these numbers have been, there has also been some outcry from employees, with many fearing that companies will force them to take mandatory vaccines. Government has distanced itself, saying that whatever companies decide to do, it's up to company policies, and they still say their priority is to encourage citizens to take the vaccines voluntarily.
Vaccination policies. In a recent media briefing, the Minister of Health, Dr. Joe Phaahla, stated government's stance on the matter.
The position of government is very clear that our priority is to mobilize and convince people to come forward voluntarily. Of course, we're not oblivious of this debate, but we leave that to, industry, employers, that's really the debate which should happen, not in the government.
JSE-listed company Discovery has been in the headlines after it announced that it's implementing a mandatory vaccination policy for its employees, which will be effective January 1st, 2022.
We feel a very strong moral imperative to do everything possible to protect our staff, both those who've been vaccinated and those who've not yet been vaccinated. We also have a legal obligation in South Africa in terms of what's called the Occupational Health and Safety Act, which mandates us to do everything possible to keep our workplaces safe. And given SARS-CoV-2 is a biological hazard, it's classified as a workplace hazard, and we know that vaccines are extremely effective at reducing the risk of the SARS-CoV-2, obviously the virus that causes COVID-19. Adding that measure to mask wearing and social distancing and improvements in our air conditioning, we think we really get to a place where our workplaces are entirely safe.
All right, let's get back to Mayowa now. Well, Mayowa, good afternoon. Thank you for joining us.
Good afternoon, Chimeze. Thank you for having me.
Well, the consumption of pasta seemed to have gained some kind of traction across most parts of Nigeria in the last 12 months. The price of pasta has spiked by 20%. Almost every household has pasta as part of its menu. Is that the reason for this price increase, which seems to be almost identical to the food inflation rate?
So pasta has gained popularity, like you said, over the past few years. Pasta is made from wheat dough mixed with water, eggs, and shipped into different sizes. And then in Nigeria, we know that spaghetti is a form of pasta that has become popular over the years in Nigeria. You see its household menus, even in restaurants. It's almost as popular as jollof rice on a restaurant's menu now. And then for Nigeria, about 15% pasta consumption accounts for about 15% of our wheat usage. So when you look at the reason for the price hike, you can actually almost imagine why when you think of exchange rate. Number one reason for the price hike that we've seen now is exchange rate pass-through effect. Most manufacturers import the wheat they use to make pasta, and then most manufacturers only get about 20% of their forex demand from the IE window. They have to source the rest of it from the parallel market, which increases their cost, and this cost is passed down to the customer. And then sometimes even assessing forex is so difficult for these manufacturers these days that they have had to shorten their supply to retail market. Another reason for this price increase is also the shortage in supply of wheat in the global market. Global producers of wheat have experienced shortage in their wheat supply, and this has impacted the price of wheat globally. In the past 1 year, from the beginning of this year, the price of wheat globally has increased by about 10%, and then we've also seen that reflect in the prices of pasta and spaghetti in Nigeria. This coupled with with other factors such as high transportation, logistics costs, high energy costs have led to the price increase we see right now in the price of pasta.
Now, the Central Bank of Nigeria, in keeping with its import substitution strategy, announced recently that it had plans to place wheat on its FX restriction list. Nigeria's largest pasta producers have Honeywell, Dangote, and flour mills of Nigeria, and they depend on imported wheat for production. Considering that Nigeria wheat production is low, and of suboptimal quality. Do you think this import substitution strategy plan by the CBN is viable?
Well, first of all, we need to look at wheat production. Nigeria is a net importer of wheat. We currently produce about 400,000 metric tons of wheat annually, leaving a supply-demand gap of about 3.6 million metric tons. And so it's quite unfortunate, like durum wheat, which is used for pasta, is the third most imported commodity in Nigeria. So it's unfortunate, really, when you think about it, that as the consumption levels of wheat increased over the years, we didn't increase our production capacity, we didn't increase our production levels. And so to make up for the supply-demand gap, Nigeria resorted to increasing our importation of wheat. And this has been a source of concern, not only to the CBN now, but even to past governments. As far back as 2012, the federal government then had this composite flour policy where they offered tax breaks to producers, millers, and bakers who mixed wheat cassava flour with their wheat flour. But to the central bank's current plan of import substitution of wheat, while we understand why they are doing this, there's need to actually reduce the amount of money we spend importing products, and we need to boost our local production. There are certain things that need to be addressed first. Number one, the challenges involved in wheat production in Nigeria need to be addressed first. Basic infrastructure needs to be put in place first before we can move to this import substitution plan. And then when you look at it, if we can do these things, it will help greatly. Then we'll be moving from a situation of, say, of 50 to 100. That's more viable than going from 0 to 100. That's not really viable. So these things need to be addressed first before this substitution plan can actually be viable.
All right. Thank you very much, Maiwa, for your time this afternoon. Enjoy the rest of the day. The African Development Bank, in partnership with the Nordic Development Fund and the government of Denmark, plans to roll out a program to strengthen access to climate-resilient water and sanitation resources in Burkina Faso, Ethiopia, Mali, Niger, and Somalia. The initiative is expected to strengthen recovery in the wake of the COVID-19 pandemic. The new initiative will enhance the sustainability of water systems through the construction or upgrade of existing infrastructure. The program will also support feasibility studies to prepare bankable projects that contribute to increased financing for water, sanitation and hygiene services, improving human health, child education, and economic productivity. Africa Finance Corporation has welcomed Egypt as its newest member state. Egypt's prime minister committed North Africa's most populous nation to become the 32nd member of the region's leading infrastructure solutions provider, opening up a potential $1 billion of investment. AFC has already invested over $100 million in infrastructure projects in Egypt, including the Egyptian General Petroleum Corporation and Carbon Holdings, a petrochemicals conglomerate. AFC has identified a further $600 million worth of projects across the renewables, natural gas, as well as the transport and logistics sectors, and expects to invest over $1 billion in total. Egypt's accession expands AFC's footprint in North Africa after Morocco joined in June 2021. And the East African Business Council has signed a memorandum of understanding with Afrexim Bank on rolling out the African customer due diligence platform known as Mansa Digital Platform. The partnership is set to boost East African companies and small medium enterprises to take advantage of African continental free trade area through accessing a centralized source of due diligence information. The Mansa Digital Platform provides a single primary source of know your customer data required to conduct customer due diligence checks on counterparties in Africa, with a special focus on African corporates, SMEs, and financial institutions. That's a wrap on the program. Thank you for watching. I'm Chimize Obi Wago.